If you're not investing with a clear system, you're already behind. Most people think investing is about picking the right stock or catching the perfect moment. It's not. It's about structure, discipline, and long-term consistency. Without a defined approach, emotions take control. And when emotions control your money, results become unpredictable and often disappointing. Smart investors focus on process, not prediction. They don't try to outguess every market move. Instead, they follow rules that remove impulsive decisions. If you invest randomly based on news or trends, you're reacting, not building. The difference between losing and winning often comes down to having a repeatable framework. If you're not investing consistently, you're losing the power of compounding. Waiting for the perfect time costs more than small market fluctuations. Regular contributions smooth volatility and increase discipline. Over time, consistency beats timing. Compounding rewards those who show up repeatedly, not those who try to be clever once. Diversification is not optional. Concentrating everything in one idea may look bold, but it increases unnecessary risk. Smart investors spread risk across sectors and assets. If one area struggles, another may grow. Without diversification, a single mistake can erase years of progress. Stability creates sustainability. If you're not thinking long-term, you're losing perspective. Short-term market drops feel dramatic, but zooming out changes the story. Over decades, growth trends dominate news. Investors who panic during temporary declines often miss recoveries. Long-term thinking transforms fear into patience. Risk management separates professionals from gamblers. Investing without understanding your risk tolerance leads to emotional decisions. If your strategy keeps you awake at night, it's flawed. Smart investing balances growth with comfort. Sustainable plans outperform aggressive ones that collapse under pressure. If you're not increasing your income while investing, you're limiting growth. There is only so much you can cut from expenses. Expanding skills, opportunities, and earning power accelerates investment capacity. Higher contributions compound faster. Income growth fuels portfolio growth. Automation is powerful. If investing depends on willpower, it may fail during stressful months. Automatic transfers remove hesitation. Money moves before you can spend it impulsively. Systems protect discipline better than motivation ever will. If you're reacting to headlines daily, you're losing focus. News thrives on urgency and fear. Markets move on fundamentals over time. Emotional trading destroys returns. Calm consistency preserves them. Successful investors ignore no's and trust structured plans. Finally, if you're not reviewing and adjusting periodically, you're drifting. Investing isn't set and forget forever. Goals evolve. Risk tolerance shifts. Reviewing annually keeps alignment intact. Strategic adjustment is different from emotional reaction. One builds strength, the other builds losses. If you're not investing with clear goals, you're moving without direction. Money needs purpose. Are you building retirement, income, financial independence, or generational wealth? Without a defined target, contributions feel random and motivation fades. Clear goals turn abstract numbers into meaningful milestones and keep you committed. When markets fluctuate, if you're not prioritizing assets over lifestyle upgrades, you're slowing progress. Many people increase spending the moment income rises. Smarter investors increase contributions first. Assets generate future cash flow. Lifestyle consumes it. Choosing ownership over appearance creates long-term leverage. If you're holding too much cash out of fear, you're losing purchasing power. Inflation quietly reduces value each year. While cash offers stability, excessive cash limits growth. Balanced investing protects against erosion and creates opportunity. Safety without growth becomes slow decline. If you're chasing trends instead of fundamentals, you're gambling. Hype cycles come and go. Long-term investing relies on durable value, earnings, and diversified exposure. Trend chasing feels exciting, but discipline builds wealth. Excitement rarely compounds. Stability does. If you're not reinvesting returns, you're sowing compounding. Dividends and gains can either fund consumption or accelerate growth. Reinvestment multiplies results over time. The decision seems small in the moment, but decades amplify it dramatically. Compounding works best when uninterrupted. If you panic during downturns, you're turning temporary declines into permanent losses. Markets fluctuate naturally. Selling in fear locks in damage. Investors who stay consistent during volatility often benefit most during recovery. Emotional control is a financial advantage. if you're investing without understanding fees, you're leaking returns. Small percentages appear harmless, but over decades they compound against you. Reviewing expense ratios, management costs, and transaction fees preserves growth. What you keep matters more than what you earn. If you're not diversifying across time, you're increasing risk. Lump sum investing can work, but spreading contributions reduces timing pressure. Dollar cost averaging builds discipline and smooths volatility. Time diversification supports emotional stability. If you believe investing requires perfect knowledge, you're delaying growth. No one has complete certainty. Progress begins with informed action, not flawless prediction. Waiting for absolute clarity often results in missed opportunity. Imperfect action beats endless hesitation. If you're not committed for the long haul, you're misunderstanding the game. Wealth isn't built in months, it's built in years and decades. Patience transforms ordinary strategies into powerful outcomes. Without commitment, even good plans fail. If you're not tracking your net worth, you're operating blindly. Income and expenses matter, but net worth reveals real progress. It shows whether your assets are growing faster than your liabilities. Without measurement, improvement becomes guesswork. Clarity creates control, and control creates smarter decisions over time. If you invest only when you feel confident, you're letting emotions decide timing. Confidence usually peaks near market highs and disappears near lows. That pattern leads to buying expensive and selling cheap. A fixed schedule removes emotional bias and protects long-term returns. If you're not balancing growth and stability, you're exposed to unnecessary stress. Aggressive portfolios may grow fast but can fall just as quickly. Conservative ones may feel safe but lag behind inflation. Intelligent allocation blends both, creating smoother long-term progress. If you ignore tax efficiency, you're giving away compounded gains. Tax-advantaged accounts and smart structuring significantly impact final results. Over decades, even small tax differences expand dramatically. Strategy must include after-tax outcomes, not just raw returns. If you think investing is complicated, you may avoid starting at all. Complexity often discourages action. In reality, simple diversified strategies have historically performed well. Overcomplication creates confusion. Clarity builds consistency, and consistency builds wealth. If you increase spending with every salary raise, you're neutralizing growth. Income growth should expand your investment capacity first. Lifestyle upgrades can follow carefully. Without intentional control, higher earnings simply create higher expenses, not higher net worth. If you rely on a single income source, you're limiting resilience. Investments provide diversification, not only across assets, but across income streams. Building passive income reduces dependency and increases flexibility. Financial strength comes from multiple supports, not one pillar. If you constantly check your portfolio daily, you're increasing anxiety. Markets move frequently, but long-term trends matter more. Obsessive monitoring encourages unnecessary reactions. Strategic reviews on a fixed schedule maintain discipline without emotional interference. If you underestimate the power of time, you're missing your greatest advantage. Early investments grow exponentially compared to delayed ones. Years matter more than initial amounts. Starting now, even small, creates momentum that cannot be recreated later. If you're not building habits around investing, you're depending on willpower. Habits reduce friction. Automatic contributions, scheduled reviews, and predefined rules eliminate hesitation. Systems protect your future from your moods. Wealth grows when behavior becomes structured and repeatable. If you invest without understanding why you own something, you're exposed to panic. When prices fall, doubt appears quickly. But when you understand the purpose behind each asset, you remain steady. Conviction based on knowledge reduces emotional mistakes and strengthens long-term consistency. If you chase quick profits, you're ignoring sustainability. Short-term wins can create overconfidence and risky behavior. Sustainable investing focuses on steady accumulation, not sudden gains. Long-term growth may look slower, but it builds durable financial security instead of fragile success. If you avoid market downturns completely, you're missing opportunity. Declines often create attractive entry points. While volatility feels uncomfortable, it is a natural part of growth cycles. Strategic investing during uncertainty can accelerate long-term returns when recovery follows. If you underestimate the impact of small contributions, you're limiting compounding. Even modest amounts invested consistently grow significantly over time. Waiting to invest larger sums delays progress. Momentum matters more than size in the early stages of wealth building. If you neglect portfolio rebalancing, you're allowing risk to drift. Over time, some assets grow faster than others, changing allocation unintentionally. Rebalancing restores structure and maintains your intended risk level. Discipline protects stability and long-term alignment. If you focus only on returns and ignore risk, you're misunderstanding investing. High returns without risk control can erase gains quickly. Sustainable strategies manage downside carefully. Protecting capital is as important as growing it. Balance creates endurance. If you assume markets will always be smooth, you're unprepared. Volatility tests discipline. Without mental preparation, emotional reactions override logic. Understanding that fluctuations are normal strengthens resilience and prevents costly impulsive decisions. If you depend on luck, you're surrendering control. Luck may influence short-term outcomes, but disciplined strategy shapes long-term results. Planning, consistency, and patience create predictable growth patterns. Structure outperforms randomness. If you fail to adapt as life changes, your strategy may become outdated. Marriage, children, career shifts, or retirement alter financial priorities. Reviewing plans periodically ensures alignment with evolving goals. Adaptation maintains progress without emotional disruption. If you underestimate the psychological side of investing, you're missing half the equation. Numbers matter, but behavior determines outcomes. Emotional awareness, patience, and discipline transform average strategies into powerful long-term results. Mindset drives performance. If you invest without clear boundaries, you may overcommit during optimism and retreat during fear. Setting predefined limits for allocation and contribution keeps behavior stable. Boundaries protect you from extremes. Investing works best when decisions are made in advance, not in reaction to emotion. If you treat investing as optional, it will always compete with spending. Optional actions are easy to postpone. Non-negotiable commitments happen regardless of mood. When investing becomes a fixed priority, lifestyle adjusts automatically. Priority determines progress. If you underestimate discipline during boring periods, you're overlooking where wealth is built. Most growth happens quietly, without excitement. Staying consistent when nothing dramatic occurs is a rare advantage. Boring discipline compounds into extraordinary results. If you constantly switch strategies, you're interrupting compounding. Each change resets momentum and often locks in losses. Sticking with a thoughtful plan through cycles creates stability. Consistency strengthens returns more than constant adjustment. If you ignore long-term vision during short-term success, you risk complacency. Temporary gains can create false confidence. Reviewing goals keeps ambition aligned with reality. Progress requires steady focus, not celebration alone. If you delay investing because of small doubts, those doubts compound into lost years. Perfect clarity rarely arrives. Action with reasonable understanding builds experience and confidence. Starting now matters more than starting perfectly. If you believe wealth requires extreme risk, you misunderstand probability. Sustainable growth relies on time, diversification, and discipline. Extreme risk may create headlines, but consistent strategy creates independence. Slow, steady expansion often wins. If you're not investing with structure, patience, and purpose, you're quietly losing opportunity every day. Markets reward consistency, not emotion. The difference between progress and stagnation is rarely dramatic. It's a series of disciplined decisions repeated for years. Change the pattern, and you change the outcome.